Welcome everyone. I hope you guys are doing good. Good evening, all of you. I can see a lot of students already getting excited for the session. I hope you guys are doing good in terms of preparation, in terms of hard work. As you guys are aware that each and every topic is very, very relevant here. And I'm pretty sure that what you have learned till now in sequence with respect to interrelationship with each other has made a lot of sense. Whether it was cost of capital, whether it was any financial leverage, financing decisions, distribution decisions, ratios, investment decisions, and you've traveled so far, just so long that we are into a very, very important topic that will be dependent on the short-term finance availability for any organization. When we talk about the sources of finance, we generally think of long-term sources and short-term sources. In terms of short-term sources, we are resorting to something called as a working capital. But in terms of long-term sources, you have already discussed whether we are looking at in terms of equity or a debt, right? So it's very, very important that we understand the requirement, we understand the intent, and we also understand the significance of the short-term source of finance. And I believe we all understand what is working capital. This is current assets minus current liabilities. And different terms we will be learning today. In fact, we have 3 sessions for working capital. So you guys will be having a session with me and with me on today and the coming week on Wednesday, and then again on the next Saturday. So while I speak, there are a lot of students who have joined. Great. Good evening, all of you. Nikita, Mansi, Manohar, Sushil, Kadambari, Ninad, everyone. So I can see all the messages. So we start our discussion for the day by talking about what is working capital. Now, working capital, as we all know, is current assets minus current liabilities. We also need to understand two terms here. That is a gross working capital and a net working capital. Now, when we talk about a gross working capital, this is generally referred to current assets. And if I'm saying working capital or net working capital, then we are saying current assets minus current liabilities. Now, we know that, okay, this is a short-term source of finance, day-to-day functioning, day-to-day operations of the business uh, depend on the availability of the working capital. A lot of corporate decisions on based on the working capital policies, whether it is account receivables, inventory holding, so on, depends on the entire, you know, availability of the short-term source of finance, and will also decide in turn the operating cycle of an organization. Now, when we say it, the two main components of working capital are current assets minus current liabilities. Let's do a little bit of a deep dive. I'm sure each one is aware here. Everyone is aware. What is a current asset? What is a current liability? Let's still try to deep dive. So current asset is something which is expected to be realized, consumed, or sold within a normal operating cycle of 1 year. So these are the assets which are realized within normal operating cycle or 1 year, whichever is longer. And I'm sure we all are aware of the examples here: cash in bank, prepaid expenses, inventory, receivables. They are all part of the current assets. But I have a question on the current liabilities. If we talk about definition of current liabilities, everyone will be saying that, okay, sir, it's absolutely opposite. These are the liabilities that will be paid off within the 1 year or operating cycle, whichever is longer. Am I correct? You guys agree with me? The general definition of current liabilities is these are the liabilities which will be settled or paid off within the 1 year or normal operating cycle, whichever is longer. How many of you agree with me? I'm sure all of you agree with me on this. Simple definition, basic old age definition. But I would like to talk about one more aspect of the current liabilities here. If you see the second point here, guys, these are those liabilities which are settled either by use of current assets or by creation of a new current liability. What does this mean? What does this mean? Let me give you an example. There was a 9 months notes payable on 31st March balance sheet. 9 months notes payable existing on 31st March balance sheet. So let me write down over here. You have a 9 months notes payable. And let's assume this is due on 15th April. Rightly classified as current liability. Rightly classified as current liability here. Now I change a little bit, or rather I give you an extended information. If I say that on 15th April, the organization, the company takes a 3-year loan to settle all the notes payable. On 15th April, company takes a 3-year loan to settle all the notes payable, which of course includes the above note as well. So what is the intent here? Was the intent to settle this note in the short term or long term? If that is what the organization has done, whether the company's intent is clear in terms of this notes payable, should this be cleared in short term or long term? I believe this intent has been pretty much validated by their action of taking a 3-year loan. That means, can we say that there is a possibility of this current liability to be reclassified as non-current liability now? Because if I look at the extended definition of current liability, which says either it has to be settled by use of current assets or by creation of a new current liability. Here we have created a non-current liability. In my example, we have, whether you can call that whatever, I'm not more into the nomenclature here, notes payable, bills payable. I'm more into the concept here. If you're saying, how did this short-term notes payable get settled? Did it require current assets? No. Did it require any new current liability? No. It created another non-current liability, guys. It created a non-current liability. Hence, there could be a question from the auditors that, hey guys, on the 31st March, this cannot be sitting under current liabilities. There is a non-current liability because immediately after the balance sheet date, you have repaid this with a non-current liability, with a loan which is taken for the long term. I hope everyone making sense out of it. I'm sure some of you would be seeing a different perspective of a current liability. Till date, current assets and current liabilities were piece of cake. It continues to be piece of cake. It's just that we are looking from an additionally a new perspective now. All okay, guys? Everyone? Mohammed says, please repeat. Mohammed, what I'm trying to say here is, think about any current liability, trade payables, creditors, outstanding expenses. So what happens in a normal outstanding expenses? In the normal outstanding expenses, you pay them, you settle them by cash. If you do not have funds, let's say you use the overdraft, which is again a short-term credit. But what I'm saying is that what if you settle a short-term current liability? You settle a current liability using a proceeds from a long-term liability. You create a long-term liability to settle that. Then we should not be calling it as a current liability. Even though the original maturity date is 9 months, but you settle it with a long-term loan. Mohammed, I hope that makes sense. Tanishka, thanks for confirmation. Kadambri, same to you. I hope everyone is getting clearer, a different perspective here. Now, of course, in terms of the terminology, I have already told you that either working capital could be gross when it refers to a current asset itself, or it refers to a net working capital, that is current assets minus current liabilities. However, that is something where we are defining the working capital on the basis of the value. There is one more way of defining the working capital, that is on the basis of time. Now, let me ask a question here. You see, on the basis of time, it can be defined as something like a permanent or temporary. You take an example of any nearby market, guys, and I would like people to respond here. Sanya, yes, so that liability is kind of reclassified from current to non-current, na? So our current liability will be reduced. So that is no longer a current liability. The example I took. Okay. I was asking you guys a question. Think about your nearby market. Any store you usually visit. You can think about, Mamta says, did not understand the concept. Mamta, what is the doubt? Mamta, I'm just simply saying, just please make a note that a liability which is classified as a current either should be settled by use of current assets or by creating another current liability. If you are taking a long-term loan to settle it, then it is a non-current liability. It is not a current liability. Okay, so coming back to my question, guys, I want volunteers here. I want you guys to think over a store, supermarket, any other shop which you visit, let's say once a week, once a month, which has a lot of racks inside the shop, right? Normally, every shop would have a racks where a lot of stuff would be kept. Have you guys ever seen those racks empty, or you will always see, think about any kind of a clothes shop or a kirana shop. When you enter inside that shop, do you see everything is always stacked up? All the sections are absolutely packed. Do you agree with me? Ever have you seen a clothes shop where some of the shelves are absolutely empty, vacant? Do you agree with me, guys? On any given day, whether it is a sale period, peak period, or a not so peak period, do you think at any given period, any given day, every organization would have some amount of inventory always in the shop, in the office, in the warehouse? That is why we are saying on the basis of time, we can classify the working capital as a permanent or temporary. Now, what is permanent or temporary? Imagine we're talking about a sweet shop. On a normal day, I'm sure everyone here who is live listening to this lecture would have a Bikaner or a Agarwal sweets or a Bansal sweets or something, right? Very, very common nomenclatures with the different sweet shops near your house. Everyone, wherever you are living, right at the corner of that red light, there will be a sweet shop. On a normal day, let's say that the value of the sweets in that sweet shop is, let's assume, 5 lakhs. But when it comes to a day like near about Holi, Diwali, Raksha Bandhan, any other festival, Bhai Dooj, Eid, whatever you want to call it as, every festival, before that, the you will see additional variety of those sweets, right? Even the quantity will be increased. So, do you agree that temporarily the inventory or the investment in the inventory has increased to meet the additional requirement of the demand during those days? So there will be peak of sales coming in those days. So we will have a permanent, or so if I say that, okay, during a week in a month, there is a festive week, and suddenly the sweet shop is keeping sweets worth 7 lakhs. I would say, okay, if inventory is of 7 lakhs, I would say 5 lakhs is permanent, 2 lakhs is temporary. And now someone would ask me, sir, sweets is perishable. How can they always have 5 lakhs? So obviously sweets would be rotating, right? So they will be refilling only it's consumed, or if it is a expiry period, it will be replaced very logically. And I think you can think of any other example also. Think about a clothes shop. Clothes shop near the sale season, you stack up with more varieties. The new, the fashion, fabrics come into the picture, and the old ones are kept for sale, and you need additional space and so on. It's pretty much very logical, right? So we are just talking about the working capital classification here. Now, we have all learned from our childhood. And when I say childhood, I'm saying that when childhood of accountancy, class 11th and 12th, okay, current ratio, ideal current ratio should be 2 is to 1, ideal liquid ratio should be 1 is to 1. Am I correct? We have all seen that in our earlier curriculums. Where I'm heading to is, okay, so Sahil says, better to eat Kaju Katli and then fresh mind go to study. Very nice. I think that's, so whatever motivates to work hard, I'm always okay with that, right? So, so guys, yeah, I was asking you about that. If you think about the optimum level of working capital, I'm sure we all have learned this 2 is to 1, 1 is to 1. But let me give you a very, very practical example. When we are looking at a working capital to be maintained at optimum level, what if I tell you there is no such answer of 2 is to 1 or 1 is to 1? It all depends on the nature of the business. Let me give you an example and let me have an example from your side. Think about, next question to you guys is, and I want everyone to answer on the query panel. I need you guys to think around your vicinity, nearby market, whether within 1 kilometer, 2 kilometers, 3 kilometers. Think about two shops. Think about two shops equally successful. Always, you could see a lot of customers. One would be having a lot of inventory, lot of working capital, and the other won't be having any working capital or very negligible working capital, very negligible inventory. Both are equally successful. You have a lot of customers over there. Think about two shops for me, guys. I need answers. This question is with context of that whether there can be any specific, preferred or optimum level of working capital ratio. Of course, every industry will have different, so it depends on various factors. And getting an answer from Sanya for perishable and non-perishable goods, it is different. Absolutely. So Sanya, that's a very, very good broad answer, but I'm looking for a specific answer. That's a very, very perfect answer when it comes to, broader definition. So think and give me two specific shops or stores. Let's see who comes first with the example here. Okay, I'm getting Bhumika says retail store and a tailor shop. Bhumika, I'm assuming by your words, a tailor shop for the women's suits and lehengas, right? Am I correct? Or we are talking about a tailor shop in a market where it can be anything. Can be anything. So retail store, it's all stacked up. Tailor shop, you don't need anything, but yes, the tailor is good. Tailors are always in demand. Very nice. Nikita says D-Mart and a small kirana shop. Okay. Ninat says supermarket for groceries and restaurant. Ninat, very nice. Dairy store. Sane says dairy store would have a less dairy. Yeah, very good example. D-Mart and a luxury car like Audi. Very nice. So Mansi is very like, it's like that. Okay. It's like both are successful, but you don't need. Okay. So Mansi, the only thing is, uh, stacking up the entire D-Mark would be as equal to stacking up Audi showroom with 10 Audis. I hope you agree with me, right? Okay. Mamta is saying, physical market and super, online market. Very nice. Sahil says financing shop and fast food. Very, very good example. I like Sania's example, jewelry shop and food store. Anmol is shop for marriage, pujan, bhandar. Wow. Anmol, I hope that's something which is you're not considering from a immediate perspective after you qualify the CA. What about others? Okay. I think I can think of very, very interesting example in my areas. One is a Domino's and I would say a pharmacy. Again, I think you guys are very well said. All the examples are equally good. Domino's again. Many of you are talking about restaurant, so that is a specific example I'm giving you. Domino's, which is always stacked with a lot of customers having, needing to have fresh pizzas, and someone is like, "Sir, it's already 6:20 p.m. and you're reminding us of Domino's pizza, right?" So Domino's is one example, and pharmacy, right? Pharmacy is always the need of different medicines, and you have a lot of inventory. So both are equally successful, right? So good guys, very nice. So I hope we are all on the same page. That means now the point here is when it comes to how much working capital is needed, that's always a question of a dharm sankat or a religious trouble. What exactly is the question here is that think from a perspective of a pharmacy. If they are keeping, they want to reduce the working capital and they want to reduce the inventory, would you go to a pharmacy or a chemist shop again and again if your two or three experiences are like whether you whenever you ask a specific medicine they are out of stock? I think after one or two visits you would like to change that pharmacy, right? So if the company plans to reduce the inventory, they may lose the sales. And if you want to increase the inventory a lot so that you want to boost the sales, you're stocking up. You're basically stocking up too much stuff, as in you are blocking your funds. And not only that, you are having less liquidity. And of course, there could be opportunity cost. So if there is an over investment, if you invest too much in the working capital, it can have an opportunity cost. Or we are talking about loss of inventory and under investment may be leading to solvency issues or loss of sales. So if you're over investing, if it is a perishable industry, you can't have it. Even if you're looking at, let's say a garment store, it could be out of stock or out of fashion rather, right? So, but you're talking about under investment that is reducing your inventory levels. It could result in loss of sales. Like customer is coming to you, you're not having enough of variety, right? So this is always a kind of a question that, okay, should we keep more or should we keep less? And that's why I think a good pictorial view of the types of working capital in terms of time, you could see there are two graphs here. Left hand side we have already discussed in terms of permanent or temporary. Or temporary is like when you were looking at peak sales, you need more inventory. But when you look at the right side, this kind of depicts a little bit of a growth expansion as well. As the company grows, your working capital requirements will increase. So as in the permanently blocked working capital is also increasing here. So it's a good picture. But what I want to discuss here is in terms of what are the factors that could determine the working capital, and then we will discuss should we keep more working capital or a less working capital. But let's first quickly understand what's the significance here. Of course, we're saying that it's a very important short-term source of finance. Of course, we need at the same time need a sufficient liquidity to ensure that you are talking about day-to-day business, day-to-day obligations are met. But that reminds me of a very interesting question and a different perspective. And I'm about to say a statement, and you guys are supposed to give me true or false. And the statement something states like this: a loss-making company, or rather, let me start with a positive note. A profit-making company can go bankrupt if they are not able to manage their finances well, while a loss-making company can survive for years if they can manage their liquidity somehow. True or false? True or false? Profit making company can go bankrupt if they're not able to manage their finances properly. A loss making company can survive for years if they can manage their liquidity in a planned way. Is it true or false? Everyone is pretty much agreeing with me. Ninat, Sanya, Bhaskar, Sahil, everything is very much true. That means you guys are agreeing with me that profitability and liquidity are two different pieces of cake, right? Sahil is like said, now it's enough, right? Earlier it was dominoes and now it's a piece of cake. So we are focusing on working capital, and we're parallelly talking about cake and dominoes. So that's not very fair. But yes, I think you guys are agreeing with me. We are all understanding on the right context that yes, the working capital is not just as important in the short term here, but it in order to ensure a long term success or rather survival of the business in the long term, sufficient liquidity needs to be maintained here. Needs to be maintained. And of course, when we discuss the investment decisions, did we consider? Did we consider for the working capital requirements? Yes, we did. We had a lot of discussion around while we were talking about the investment decisions, because the new projects could have initial working capital increase and a release of working capital later on, or reduction in a working capital initially and reinstatement later on. So we discussed this in the capital budgeting already. So we had discussion around this last week. But of course, there are factors which could decide your requirements of working capital, like increased production levels specifically, or increased sale. As I said, that even the seasonal sales could lead to it. And of course, the graph we showed, where the permanent working capital was increasing upwards, where a firm is generally increasing the scale of operations. That means you are indicating a growth here, right? So, what are these factors that will decide how much working capital is required? Let's look at the determinants of working capital as well. Now, in terms of determinants or keeping an optimum working capital level, various factors could be considered. First one, this is something many people have answered already: nature of business. Someone was talking about perishable versus non-perishable, right? That is also the second point: types of products. So first one is nature of business, right? We already took an example of a Domino's versus a pharmacy. Domino's always reminded me of one of my corporate experiences. In a lot of companies, you are talking about a scenario where you have town halls, you have monthly connect. And I remember we used to have a lot of funds on some of the monthly connects, specifically. Let's say if it happens to be somewhere in the middle of the month, or a connect used to fall on a Friday. And I remember in one of my corporates, we had this monthly connect where we used to have a 5 to 10 minute session of a puzzle or a quizzes, and it used to be a more of a or icebreaker session for everyone, so that everyone is energized back to the work. And one of the questions someone asked on that day was, "What is the opposite of Domino's?" I can't forget that question, throughout my life. Would anyone like to try to answer that? Someone really asked this question. What is the opposite of Domino's? Rehan is like, "No more food, please. We we are already craving here. You're already teasing." Someone is like, "Sir has not had their lunch today, it seems." No, I have had my lunch. Just that the examples cause for Domino's again and again, right? Anyone would like to answer that question by any chance? Anyone would like to play a sport here? The question that employee asked in that company was, "What is the opposite of Domino's?" I don't know if like, and I think I can see a lot of answers here. Ninad says Dhaba, Sahil says KFC. Vaibhav had a very very good answer. Vaibhav, actually, that was the majority of the answer came up with the many employees over there was a Pizza Hut. The opposite of Domino's. So, but the question was opposite, but not the competitor, right? Someone came up with the example of a Bata showroom. So we asked that guy, "What is your logic of Bata showroom?" He said, "No, in my locality, right opposite to Domino's, on the other side of the road, there is a Bata showroom." And like everyone was laughing aloud. But, but, okay, I'm getting some answers. Akash, the biggest clue is that was a PJ. Akash, the clue is that was a PJ. That was, of course, not a real question. Uh, Anmol says Haldiram, or English says juice, or so the correct answer he gave, without wasting any further time, the correct answer he gave was, "Domi doesn't know." You don't need to kill me for this. You can find that guy. No, it was not me who asked this question. It was the other guy who asked that question. Domi doesn't know. I cannot forget that. And I actually advise that guy that it's better that you apply for chartered accountancy course. You will do well over there. Right? Anyway, so the point number one and two is clear to everyone. Nature of business and type of products. Okay. The operational efficiency is also very, very important here. So we talk about the third one now, operational efficiency. So if the company is pretty much efficient in their operations, so if you're looking at a highly, efficient operations, that means we are looking at, okay, the high the efficiency is, the working capital requirement may reduce or vice versa, right? Then we are talking about respective policies with respect to components. That is something we'll discuss later on. Inventory techniques, receivables policy, like credit policy, and so on. Cash holding requirements. All those will decide on the levels of working capital. Price level changes, short-term financing options. So let's say if you have so much of a short-term financing option, or rather you have a less short-term financing option, you may not be able to anyways go for a higher level of inventory. Market and demand conditions is very, very important. Let's say if there is a more demand than production, of course, then talking about a less inventory, what does it mean is in terms of uh, what will happen in that case. If you're looking at, okay, demand is more than the production, That means in this case, you are talking about less inventory, but of course, you have to meet that demand and you have to think of how do we increase our inventory. Manufacturing policies, steady production, steady production or a seasonal. So if you're talking about a seasonal, in the case of seasonal, you will have a need to have more working capital. Think about, any manufacturing organization who operates in shifts, right? Factory operates in shifts. Let's say in a normal scenario, a factory is operating in 2 shifts, but in terms of the seasonal scenarios, they may have 3 shifts, right? Even the credit policy will determine even the credit policy will determine the working capital. Let's say if you have a lenient credit policy, that means you will have a more amount will be blocked in the account receivables. But if you have a strict or a shorter credit policy, then of course you will have a less amount blocked in receivables, but that could impact in your credit sales also, because if your credit competitors are giving you more credit period, then you are in trouble. So the combination of these factors would be considered for planning the working capital, guys. That's very, very important that we understand this on the correct note. I hope everyone is on the same page. No questions as of now. Because now what we'll be discussing here is, guys, we will be discussing how do we arrive at a trade-off? How do we arrive at a trade-off in terms of the working capital? And we are always are playing like a seesaw kind of a game, right? Let's say you are playing a seesaw game. On one hand there is a profitability, on other hand there is a liquidity. So if I say that, if okay, you want to increase liquidity, you want to block less in inventory, you will have less sales, less profitability, or vice versa. It's a seesaw and you have to balance that seesaw. So let's understand that trade-off as well. So working capital management takes care of 3 E's here: economy in financing, efficiency in utilization, and effectiveness in achieving the intended objectives. So generally what happens is, whenever you hear these two terms, efficiency and effectiveness, efficiency is how do you use it, and effectiveness is what do you want to achieve. That means it is more with respect to your objectives. Efficiency is with respect to how do you use your resources. Economy is always in terms of saving cost. So working capital management evolves around working on economy, effectiveness, and efficiency. However, the working capital management itself considers liquidity and profitability on one note, and investing and financing on other side. We will talk about liquidity and profitability first. So imagine this is a seesaw game. On one side, liquidity is sitting; on other side, profitability is sitting. You want more profitability, your liquidity will go. You want less profitability or you want more liquidity, you say your profitability will go down. If you say that okay, your liquidity or you want more profitability, your liquidity will be at stake. Let me give you an example though. Anmol has a very, very good point. Effectiveness to achieve result, efficiency to achieve result with minimum cost. Very nice, Anmol. It's like, how do you want to achieve it? So let me give an example. Yeah, the first one, right? Inventory. So inventory may, if I want to have a higher profitability, what do I do? Keep higher level of inventory, keep whatever types of varieties of the products in my store. I want keep everything what customer may want on a rainy day. Higher level of inventory. That means what I'm saying is I will be having a fewer stock out, right? But that is an advantage, right? Of a higher level. But if I want to understand its disadvantage, what would be the disadvantage, guys? Disadvantage could be, perishable. If it could be perishable, or it is out of fashion, or more funds are blocked here. Whereas if you're talking about you want to keep less inventory, that means we talk about keeping a lower level of inventory here. We are saying that okay, that would help in your liquidity, that will help to enhance liquidity, but it could result in a stock out or loss of reputation. As I said, if you're keeping lesser inventory, there could be repeated instances where the customers come to you and you do not have the desired product. So it's like both the sides: more inventory, more sales, fewer stockouts, but you have its pros and cons. So that means we have to arrive at some kind of trade-off. Sanya, yes, absolutely. So opportunity cost will be there, right? Opportunity cost will be there. So if I'm keeping more inventory, there will be an opportunity cost, right? So I'm keeping my funds blocked over there, and we'll discuss that later on. We have to arrive at a trade-off here, Hardik. Very nice, very nice. So we have to trade off. We have to arrive at trade off, and for that there are a lot of policies or rather practices which can help us to strike that balance. Like for inventory, we'll discuss something like a just-in-time or economic order quantity. I believe, you have studied in your other curriculum already. So there are mechanisms to strike a correct balance here. Talk about receivables. So we will spend a lot of time on receivables in later sessions. Specifically with respect to evaluating the credit policy. So let's say if you're talking about a higher credit policy, that means relaxed credit term. That means customers will be happy. They need to pay later. More sales. Amazing, right? But the disadvantage could be bad debts. More funds will be blocked. And if you want to have a lower credit period, that means more cashes, you want more liquidity, but the customers may not be too much inclined because competitors may be giving a larger credit period. Hence, you should have a good mechanism for evaluating the credit policy here. Or think of uh, scenarios like a factoring or pledging, right? Factoring wherein you want to sell your receivables to a third party who will collect it for you and you get the collection today itself. So those are the mechanisms here. Nineth says EOQ or yeah. So obviously, Nineth, one particular mechanism of working capital management may not be applicable for all the industries. Of course not. So EOQ may not be even applicable for a service sector, right? Of course not. You're talking about for majorly for the manufacturing setups. Same, I think same holds for just in time, but yeah, just in time can also hold up for a traders as well, where you have a supply chain spread out geographically. Okay, cash and cash equivalents. Now, cash and cash equivalents, when we're talking about in terms of a higher level, if you're talking about keeping a higher cash with you, your creditors will be very happy because you will be paying them on time. Your reputation will be amazing. However, you will be losing on some kind of a temporary investment opportunities. Some interest could be an opportunity cost here. And if you're talking about keeping a lower level, less cash, that means you can invest in those venues. But of course, the negative side of lesser cash is that what if you need something immediately or to settle your unknown or other unexpected requirements. For this, very, very important that there in every organization there is a treasury function which license with different departments such as order to cash, payable, procure to pay teams, or even the payroll, to get an idea in what are the collections anticipated, what are the payouts that will be happening, and they kind of jot down the inputs from different teams and they draft a cash budget for the entire year, month on month. That is very, very important to strike off the correct balance. Okay, what do we do if there is a shortfall? What do we do if we have excess cash? I remember in terms of cash and cash equivalents, when I was working with one of the companies, I believe it was Whirlpool. When I was working with Whirlpool almost a decade ago, a treasury team used to sit next to me, and I could hear that guy talking to the bankers, negotiating with them the interest rate for short-term deposits. And he was negotiating and he was asking questions like to the other side, "Hey Samir, how are you? What is the interest rate going for a 4-day deposit, 3-day deposit? What is the interest rate? What if we deposit more than 20 crores? Can you increase by 2 basis points or whatever?" I was like very much surprised. I'm sure those of you go to banks or have been visiting banks with your elders with respect to any fixed deposit or any temporary investment, you may be seeing deposits to be made for minimum 1 year, even 2 years, 3 years, 5 years. Am I correct? Those of you have visited bank with your elders, and they were talking about 3 days, 4 days. What happens over there is even that 4-day deposit, even if it yields an interest rate of let's say 3.7%, could actually result in an interest of that much amount, which could help in paying two people's salary for that month who are working in admin department because of the quantum, because of the amount involved. And that's why the cash budget is very, very important. That if you have a temporary surplus somewhere, don't you want to invest somewhere so that you get adequate returns? Very, very important. Now we talk about prepayments. Now, prepayments again, generally, most of the organizations cannot plan prepayments, but yes, sometimes they inadvertently do. As in, like, let's say if you want to prepay or take AMCs, you want to get rid of the headache of future increase in cost. So basically, if there is an inflation later on, or when you have already prepaid, you're always in a good position, right? But if you want to keep a lower prepayment, then of course you are saying that okay, you are maintaining a liquidity. But generally, it's not a big scenario. It's like a simple cost benefit analysis can help you to achieve this. Now the last one is payables here. So the payables in terms of the trade off between profitability and liquidity also is very important, because on one hand we are thinking that what if we can defer the payables a little bit. Now mind you, it's a very ironical situation, right? To every to every receivable there is a payable, right? If I'm having a receivable, that could be a payable for another party. So working capital management applies to both the organizations. I would want to do basically expedited collections, and they would want to defer the payments. So how do we negotiate? How do we strike off a balance? Because now from a payables perspective, as an organization, I would want to defer the payments, but not beyond the deadline, not beyond the last date. I don't want to ruin my reputation, right? But if I can utilize the credit period from a payable perspective, I could invest the fund somewhere else temporarily if I'm getting some temporary investment opportunities. But if I'm not bothered about that, I want that, okay, I want to keep my vendors happy. I want to pretty much pay them ahead of time. Then of course it will definitely leave a good image for myself or for my organization. So I think again there are policies which we'll be discussing later on. I hope everyone is doing good in terms of evaluating the trade-off or the of the working capital requirements based on profitability versus liquidity, guys. I hope this makes sense to all of you. Any questions, please let me know. Good. Okay, very nice. So now we talk about from a other side, scope of working capital with respect to investing and financing. Of course, that's pretty much you have been doing already. Investing is like investment in working capital relates to how much, and financing is from where, right? So, how much optimum working capital depends on factors which we have already discussed, right? Depends on various factors. Various factors. How much? Financing is like where from. That's something which is you already know. You're not talking about a short term or a long term. Now, very interesting. Uh, when we discuss permanent versus temporary working capital, do you agree with me that okay, permanent working capital could be finance from the long term sources of funds and a temporary working capital for the short term sources of funds? Although working capital itself is a short-term source of finance, but if I understand it carefully, that okay, there is some amount of working capital that stays invested always in the business. I don't want to touch that. It is more or less backed by a long-term source of funds that's get invested in the business, right? Although it is rotated, like I'm not saying like if there is a 20 lakhs of inventory, that means that stays same from 2014 to 2028. No, 20 lakhs means a value 20 lakhs. Of course, the articles may be refreshing, and refreshing, right? So now we are looking at three different policies, organizational policy that could decide how much working capital I need to keep. One is basically they're saying that two are the extremes and one is the balance in between the two. So on the left hand side, you could see aggressive. Aggressive means you are pretty much confident. Aggressive means okay. Some students get confused. They say aggressive means like okay, we are aggressive, we want more working capital. No, aggressive doesn't mean more working capital. Aggressive means like we are willing, we are the risk takers. We are very much confident in our supply management. We are pretty much confident in our vendors, supplies, our supply channels, and we are sure that a lower level of working capital could be okay. We are aggressive. We are fine with a lower level, less inventory, strict credit policy, less cash. But people like conservative, right? I think in India, we're talking about conservative, right? Right here, I am sitting from my seat. I can see each one of you over there, very conservative in various aspects. And I can give you examples, right? Like the best example could be how many of you, if you have to wake up 6:30 a.m. in the morning, keep three alarms. 6:10, 6:20, 6:30. How many of you are going for a function with the family? You're locking the door. You come back and check the door two or three times unless it actually breaks. Or how many of you check the vehicle door after locking your car again and again? What is that? Conservatism. We don't want to take a risk, right? And like some people, like Sahil is like, how does he know us so well? And I'm pretty sure most of you can correlate with these instances, right? Am I sure? I'm pretty much confident on this. We're talking about conservative, not from an individual perspective here, though. We're talking from a corporation perspective, from an organization perspective. So conservative means like organization is not so confident. They don't want to people to take risk. They don't want organization to take any risk. They want okay, we want to be always on a safer side. We always want to keep margin of safety. We want to have more inventory, higher liquidity. We don't want to make sure that invest our funds, excessive funds in a scenario where it is stuck, and liberal credit policy. So we want a higher. Now, the point here is in terms of aggressive versus conservative is in terms of aggressive, the positive side is that you are okay with a less investment, but the negative side is you are not able to boost your revenues. But the conservative have the positive wherein if you have a lot of variety, you can have growth in sales. You can improve your goodwill. But of course, the negative side is, of course, you have opportunity cost. More funds are blocked, higher risk of bad debts. Sanya says, I do all of that. So I think she kind of pretty much agreed to whatever I said in terms of the conservative nature. Okay, Hardik is very, very disciplined guy. Hardik says that, okay, I keep only one alarm at 5:30. Okay, and Mo says, bike handle and door lock are replaceable, so don't worry, we will keep on checking thrice. Okay, okay. And Mamta is like right now going and checking her scooty. Very nice. So I think Gunjan also does with one alarm. So I think yeah, I think then I'm mistaken, right? 20% of the students are very smart these days. They don't need more than one alarm. Very nice. Very, very nice. Okay, so I'm sure everyone agrees here that okay, in the terms of aggressive versus conservative, these are two extremes. So many organizations, a large group of people fall here. They want to strike a balance in between, moderate. You want to balance risk and return. So it's like following a midway approach. In Hindi, some people say, while you're shopping, what is the phrase you guys use while shopping? While you're negotiating, ठीक लगा लो भैया, something like that, right? So you're talking about like midway approach. You don't want to. We want to probably get a good level of inventory, a high level of inventory, but we may be not be giving a larger credit period when it comes to receivables. So that's okay. You can have aggressive in one component and conservative in another component. Overall, you want to follow the moderate approach. That's about the working capital policies, guys. But if you look at the requirements, understand the processes, of course, it's very, very important that we understand this could differ from nature of business, nature of industry as well. As you can see graphically as well, of course, conservative policy would end up giving the maximum working capital, and the aggressive policy is kind of having almost negligible working capital. Like you can see the differential between the fixed investment and the aggressive policy is almost negligible, right? So that's about your working capital policies, guys. But now we also talk about a very interesting ratio, which kind of indicates whether you are following the aggressive or conservative working capital policy, and that's nothing but current assets upon fixed assets ratio. So a higher ratio means you are talking about a higher working capital. Lower ratio means we are talking about a lower working capital or aggressive policy. So let's see this. So optimum level of current assets to maximize shareholders wealth, that's what you would want. But the requirement of current assets will ideally will go up with expansion, but it may not go up in the same proportion. It could be at a decreasing rate because you will be getting efficiencies in learning curve, and you'll be getting more efficient in the processes. So that means, we have to be very, very careful in terms of requirements, right? If you're talking about like higher ratio, it's a conservative, lower is aggressive here, right? So So in terms of example on your screen, we are looking at EBIT, same EBIT, different current assets. So let's mark it as A, B, and C, three scenarios. And you are looking at three different scenarios in terms of the total assets. Why? Because the current assets have changed. So we are looking at 10 lakhs, 9 lakhs, and 8 lakhs. So when we are saying current assets to fixed assets, we are only looking at the division between the 1/2 here. But we are also looking at one factor. So when we are looking at 1 divided by 2, which is clear cut a scenario of an aggressive policy when it comes to option number C here, because here we are saying that okay, lesser current assets are blocked, so it's an aggressive policy. But if you look at the return on total assets, guys, that's the very, very good indicator. This is the indicator when we were looking at profitability versus liquidity. What I'm trying to say here is that if you want to be a little aggressive, take more risk, keeping less working capital, you may get a better return on total assets. Why? Because with the same earnings, you have lesser funds blocked. Very logical, right? So lesser funds, or rather, you are kind of generating same earnings with lesser funds. So of course, your return on capital would be higher here. Make sense, guys? Everyone? Pretty much logical, I guess, right? So again, if I'm saying that okay, you want to have a conservative approach, you want to have more assets to be blocked, however, you're not generating more earnings, then of course your return on assets would be on the other way around. Now is the time. Now is the time where we start looking at something called our operating or a working capital cycle. What is this operating or a working capital cycle? This is a cycle which indicates the length of the time between company buying their raw materials and actually realizing the cash from the sale of their finished goods. So what happens in a typical manufacturing organization? Think about an organization which will have the longest operating cycle. I would say manufacturing organization could be biggest example for that. You would have raw materials, you would have WIP, you would have finished goods, you would have vendors, you have customers, right? You would have tasted everything here. So it generally would start with purchase of raw material, because if you purchase the raw material, you would pay them after some credit allowed by your vendors. So from the purchasing of the raw materials to the point where receiving the cash from the realization of the sales, that's your entire working capital cycle or operating cycle. Uh, Manish says, why EBIT is constant? Won't policy impact sales? Uh, Manish, again, when we are talking about a policy impacting the sales, there could be expenses also. We are just taking an example. But you are absolutely right. There could be a scenario where if you have brought in efficiencies, even your profit will be higher. So the idea was to prove that the return on capital would be higher. And if I go by your words, it will be more better actually, right? That's what you're trying to say. So that's absolutely okay. So we are saying EBIT is like revenue minus expenses. So maybe you have more revenue, maybe some more direct expenses as well, right? I hope that makes sense. Okay. Coming back to the components of a working capital cycle, guys. So as you guys can see, there are 5 components here: R, W, F, D, and C. R stands for you buy raw material. Is raw material introduced in the production right on the day when it is purchased? I'm not sure. So you may want to keep some raw material in stock. That depends on what is your production cycle. A lot of factors could decide on how much raw material you need, lead time and all. So you will need a raw material to be stored, raw material storage period. Similarly, question coming in from Sahil. Sahil says, which approach is most better, aggressive, moderate, or conservative? Sahil, the answer is, let me give you a party here. Party of lot of various options as answers. Sahil, the answer is in front of you for your question. All these factors will decide, right? So different industries, different businesses will have different choices here. That's what we already discussed, right? Make sense? Okay. So coming back, we're saying raw material storage period is one. Now, the raw material goes through a process, production process, before it becomes a finished good. That means with the production time in place, there could also be a scenario, something called a work in progress holding period. So you may not, the production process may be longer. It may not be shorter here, and hence you will have a WIP holding period. Question from Gunjan: what is best, more inventory, less inventory? Gunjan, no specific answer. That's what I just answered to Sahil. Depends on your requirements, depends on your business. So I can bounce back with my answer earlier. For a pharmacy, more inventory is best. For a Domino's, less inventory, you don't have a choice. Sorry, Sahil. I have to take again example of Domino's. So I think I'm taking too much. We're talking about too much pizzas, which calls for a pizza party after the class, right? Not between the class. Okay, so we are looking at a WIP holding period. We are having a raw material storage period. Then, guys, when the finished goods are produced, when the finished goods are produced, are the customers standing outside the factory gate and waiting? When the finished goods will be thrown from the terrace, or will it take time to convert it into those sales? I guess you got get my answer, right? If the finished goods may not be sold as good as soon as they are produced, it may take time. You plan everything, right? We talk about the budget, right? You plan your sales budget, then accordingly your production budget, and then accordingly your raw material, labor, and everything, right? So it is very imperative that we understand this in a right context, that yes, there could be some finished goods inventory as well. It may not be sold on a day one. So and also remember we discussed that, okay, some amount of inventory you always have, permanent versus temporary. So your finished goods storage period before the finished goods are actually sold. Once you're selling the finished goods, once you're selling the finished goods. So let me quickly try to draw a line here. So you talk about a raw material, you talk about a WIP, finished goods, and once you are selling the finished goods, you could be having a scenario of, let's say, in terms of, just give me a quick second. So I just want to show you something on this number line. So you have a raw material period, then you have a WIP period, and then we are looking at a finished goods. But once you are selling it, right, that's where our credit period is. That is your AR. So this long is my gross working capital cycle. What I've mentioned in the green here. This is my gross operating cycle or gross working capital cycle. But if I have to understand what is my working capital cycle, or what is a net working capital cycle, or what is my cash conversion cycle, do you agree that throughout this green time frame, throughout this green time frame, there is something you have availed also? So let me use a red color here. Let's say to pay your vendors, you took this much time in the red. This much time was given by the vendors. Do you agree, guys? So that means you may not be deferring or calculating your operating cycle just by looking at the green time frame, but during that green time frame, you also took some benefit, which was kind of provided by your vendors, suppliers of raw materials. They would have given you 30 days. So to arrive at the net working capital cycle or operating cycle, you have to reduce that time, reduce that number of days. So for actual calculation of operating cycle, we'll say R plus W plus F plus D minus C. C stands for credit period allowed by the suppliers here. Because that's right from that duration. While the production process was going on, while the WIP converted into finished goods, while you converted it to sales, you gradually paid your creditors. You did not pay the creditors on day one. Even they allowed, they kind of provided some kind of a credit period here. Make sense, everyone? I hope this is good. Good to go to all of you. Quickly checking, is everyone doing good here? All are in good shape. Okay, one quick question, guys. As an organization, if this is my operating cycle length, would you want a larger operating cycle or a longer operating cycle or a shorter operating cycle? Let me have your preferences. Again, I know the answer depends on the industry. That, sir, in some industries, operating cycles could be longer, some industries it could be shorter. But if given a choice, what would you want? A longer operating cycle or a shorter? Gunjan, the equation talks about, Gunjan has a question on the equation. So, Gunjan, the point here is, while there is a time frame involved in purchase of raw material, you store the raw material, then you produce convert the raw material into WIP to finished goods, then you sell those final finished goods, then you collect from your debtors. That entire time frame, we'll take an example also, would also involve a time period parallelly where you would have taken some benefit from your vendors. So we are reducing that time period allowed by the creditors. Okay, majority people answering me that if given a choice, you would always want a shorter operating cycle, right? Bhaskar is saying medium in between. Anindita says operating cycle depends on working capital. I think I agree with with Vaibhav's answer, because Vaibhav is giving me an answer shorter, but also is giving me a very, very interesting note in the bracket. He says more frequent profit. So if you are looking at my hands, what do you think, guys? The faster I churn my hands, better it is, right? More exercise I'm doing. So faster I churn my hands, right? So if I slowly churn my hands versus faster, so if the company is having a lower operating cycle, that means more number of operating cycles in a year, better it is. Of course, it depends on industry. That I already told you, right? Okay. So Manish says, question, when company have different SKUs, wanted to have the yes, of course. So Manish, so working capital would be coming from different SKUs now. Why would you? So that will be combining from the different SKUs. That's okay. That could be absolutely possible. Okay. Sanya, I agree with you. It's just that it could depend on the industry, but I absolutely am with you that, obviously as a choice, you would always want a shorter operating cycle. Okay. Even many people are saying that a longer operating cycle, I would also say that even if you're saying that your operating cycle is longer, you would always try to shorten a bit. That was the intent of the question. The target would be always to bring in efficiencies, right? Efficiencies, effectiveness, and economy, right? Absolutely perfect. Bhaskar says efficient and effective. That's where the answer lies. Okay. Can we quickly look at a small illustration here of Dhoni and company? Okay, I think the question probably needs to be updated from Dhoni to, I think, Dhruv and company, right? That's what in trend, I guess. I'm not sure how many of you are updated. So the current trend talks about of not Dhoni and company, but Dhruv and company holds raw materials on an average for 45 days, and it gets credit from supplier for 30 days. Production process needs 25 days. Finished goods held for 15 days. And 45 days are extended to the debtors. So that means if you are looking at the raw material, I'm holding the raw material for 45 days. And my production is taking time for 25 days. Finished goods are held for 15 days. And then I'm giving a credit of 45 days to the debtors. But mind you, while I was storing the raw material, somewhere here within these first 45 days, there was a 30-day period which was allowed to me by vendors. Allowed to be my vendors. So that can be reduced. That's an overlap. Yeah, 45 days may say 30 days so allowed to me also, na? So that is reduced. So how much we are getting here? So we are getting 100 days of operating cycle. Manish says we can also say shorter is less risk as we studied in paper. Absolutely perfect, Manish. That's superb. That's kind of interlinking the learnings here. Gunjan says in clothes industry, low working capital is good because of changes in trends. And Gunjan, also a lot of factors depend on your licensing with your supply chain. You know what is happening is like is what is the policy with your vendors in terms of whether whether inventory purchased is by you is yours or they keep on replacing the older models. So it's a lot of factors. Gunjan will depends, right? You talk about perishable food or kirana store as and when the food items are expired, they get replaced by the vendors itself, right? But why we were discussing this, okay, if I quickly want to see a formula, number of operating cycles in a year, what how we calculate this. So if I talk about in number of days, would you think it will be like 365 upon 100 in my example? If another example is a 90 days, 360 by 90, so it's giving me almost 3.65 operating cycles. So basically, all of you agree that every organization would have love to have more operating cycles in a year, because with each operating cycle you will have churning of the same resources. You're generating more and more profits, reinvesting earning. um Sanya, you are asking me why reduce credit days, Sanya, because if you talk about from a calendar perspective, let's say this raw material were purchased from on 1st January. Sanya, I hope you're with me. If the raw materials were purchased on 1st January, they were stored for 45 days before they went into production. That means 45 days is still Valentine's Day, 14th Feb, right? But don't you agree? From 1st January to 14th Feb is when you are waiting for that raw material to be entering into the production. During that 45 days, the first 30 days is what even the vendors allowed me. I did not have to pay those raw materials until the January 30th. Did I no? Was I supposed to pay the creditors? Before 30th January? No. So my actual operating cycle should actually start from 30th January then. But since I'm including from 1st January, I have to subtract that 30 days. Sana, I hope it makes sense. Bhumika says if operating cycle is longer, then more working capital is required. But if my operating cycle is shorter, then number of operating cycle will be more. No, so within one, okay, Bhumika is now riding on a bicycle. Bhumika is a very, very valid question. She says if operating cycle is longer, I need more working capital. If the working capital is shorter, I need less working capital. But when we are saying more operating cycles in a year, we need more working capital. So where do I go? So Bhumika, but within one cycle, you need less working capital, right? So can I say that the same working capital can be churned again and again? Think it that way, na? Bhumika, you need to add up those working capitals. The same working capital you can rotate multiple times. That's the operating cycle for you. That's the beauty of it. Everyone good, guys? I hope Bhumika, you got your point. I think that's a classic question, though. Uh, Sujal, you will get the update soon. Okay. So if everyone is doing good here, now let's start looking at how do we calculate the different components of the working capital. But of course, before we go there, we all know time is money. That means how or what are the contributors to the working capitals. If you collect your data faster, then you release cash from the cycle. If you collect receivables slower, then you block your cash. If you keep lesser inventory, you free up some cash and so on. So very, very basic stuff. But let's now understand how do you calculate the operating cycle. Now, as we see, there are different components: R, W, D, the RWF, D minus C. Now, you could see a lot of formulas here, but very soon you will realize, guys, that if you understand the rationale, the logic, you will not be required to remember or memorize the formulas. Just understand the concept, right? So there's few formulas given to us. We're saying raw material storage period. It's average stock of raw material upon average cost of raw material consumption per day. I think what is important in this is we're seeing average stock of raw material that any organization would like to keep here upon average cost of raw material consumption per day. Now, this per day is something will help us in calculating the raw material storage period in days. Raw material storage period in days. Because what would be the average stock of raw material, guys? Average stock of raw material would be, I guess, what do you think? Would be number of days into cost of raw material, something like this. So I'm trying to go behind the formulas. So you don't need to mug up or memorize these formulas. Try to understand these. Similarly, work in progress holding period. So whatever your average work in progress inventory divided by average cost of production per day. Finished goods storage period, average stock of finished goods upon average cost of goods sold per day here. So you're saying per day. Similarly, receivables, average receivables upon average credit sales per day. So we'll get number of days. So what we're calculating is number of days here and so on. So I think one way is you guys can always look at these formulas, try to calculate, but if you understand this logically, you will be able to solve it better. So what we can do here is we can quickly go to a question here and try to calculate the operating cycle for ourselves. So let's do that. So let's look at a question with respect to a net operating cycle period and the number of operating cycles in a year. First, let's calculate net operating cycle. So a lot of information given to you here. I want you guys to calculate. Let's start with the first one, guys. Who will tell me what is the raw material storage period here? Raw material storage period. How many number of days generally this company seems to be storing the raw material for? So they are giving you raw material inventory consumed during the year. They're also giving you average stock of raw material. So let's say who gives me the answer for the first one? I can actually help you guys here. The way to look at is, guys, when I think that, okay, what is the average stock of raw material in number of days, right? So we're saying raw material storage period. So if I say, okay, I need to calculate raw material storage period, I definitely need, first thing is what is my average inventory that is required? Average inventory is required or average inventory of raw material that is given to me is 1 lakhs. And then I will have to calculate, okay, that is average inventory of raw material. How much raw material I need to have every day for a consumption? How much raw material is my production process consuming every day? So what I will do is, I will see, okay, have they given us consumption? Yes. So raw material is consumed is 12 lakhs. So we say daily consumption. So daily consumption is like 12 lakhs. And they've given you to use 360 days here. So if my average inventory of raw material is 1 lakh and my daily consumption is 12 lakhs divided by 360, which gives me 3,333.33. That means my raw material storage period. That clearly means what we are looking at is my raw material storage period here is 100,000 or a 1 lakh divided by this. So if you do a quick math here, you should be getting 30 days. So that means I am holding the raw material for 30 days here. That's how we are going. Understanding the rationale. So with this, let's quickly calculate. I'm sure everyone got 30 days here for raw material. So who will give me for WIP, guys? So raw material, that's 30 days. Who will give me WIP? I will wait for your answers for WIP. For WIP, you would need what is average WIP inventory is 50,000. And you'll say, what is your daily cost of production? Cost of production is given to you as 10 lakhs. 10 lakh divided by 360 is kind of 2,777. I think I'm getting a WIP of, let me just wait for your answers. Are we looking at WIP period of 18 days? Yes, very nice. I'm also getting this 18 days. Then we are having a finished goods storage period. Finished goods storage period, we have a cost of goods sold and average finished goods inventory. I guess some of you are getting finished goods storage period is also 18 days. Uh, Debtors collection period is already given to us 45. So if I add them up, the gross operating cycle we are looking at as 121 or what? Or triple one, right? Triple one. But then there is a parallel benefit we availed from our creditors, that is 30 days. So are we getting an operating cycle of 81 days here? It's also called as a cash conversion cycle or a net operating cycle. So net operating cycle or cash conversion cycle is 81 days. 81 days. And if there are 81 days operating cycle, how many number of operating cycles in a year, guys? If there are 81 days, how many number of operating cycles in a year? 360 upon 81, you're getting 4.44. So larger the number of operating cycles in a year, better it is. I hope. Very nice. So I think 4.44 is what majority of you have answered. Very nice, guys. So we all know how to calculate the working capital cycle, but we will move to a calculation of the working capital, guys. So what we'll do is 7:19 by my clock. We will take a 10 minutes break, and once we are back, we will be resuming our discussion for understanding what are the components of working capital. We all know what are the components of working capital is like current assets minus current liabilities. How do we compute in terms of the amount, how much working capital may be needed? We would need to calculate the raw material inventory. We need a WIP, finished goods, even any cash and bank requirements. What is the creditors we may have? What is the working capital in terms of the outstanding expenses or wages and so on. So we will be continuing our discussion after 10 minutes break where we'll be discussing and jumping and doing a lot of practice for the working capital itself. Guys. See you on the other side of the break after 10 minutes. Great. Welcome back, guys. I hope everyone is back after much deserved break. And we are on to for yet another second half of working capital management, first session of the series of three. I'm sure you guys are all back. So as you guys can see, now we proceed after understanding the working capital cycle, the actual calculation of the working capital. We have discussed so far, we have traveled so length to understand the policy, conservative, aggressive, moderate. Whatever it is, we need to know what is the working capital. Maybe needed. Because see, at the end of the day, unless and until you don't know the working capital requirement, how would you decide where to finance it from? Right? How much is the permanent? How much is the temporary? Whatever it is, you need to know what is the working capital requirement. Now I can again see a plethora of formulas on these slides. Two choices. The two choices are bhag lo or bhag lo. What are these choices I'm talking about? One bhag lo is run away and mug up, and the other option is participate. The bhag lo, the second bhag lo is the participate, understand, and then apply. So I'm sure you guys would go for the second option. Let's look at each formula. This is like not a it could be a formula, but if you understand it, you don't need to create a burden on your head. Right? If you see raw material inventory here, and if you see okay, how much is the production in units, estimated production, and if dividing by 365 days, let's start with days. There is a month option as well. Let's say 365 days. What will you get, guys? Daily production. If I said daily production into estimated cost per unit, let's say 1 unit of finished good is requiring you know a rupees 3 of raw material. So daily production into estimated cost per unit, don't you think it's like what we are getting is a daily raw material cost? That's what I'm getting. And if I multiply this by average raw material storage period, I get the raw material inventory. That's it. I get the raw material inventory. If I know the daily raw material cost, I would get to the raw material inventory I need. Similarly, for the WIP inventory, guys, estimated WIP units, it divided by 365. So daily WIP units multiplied by the estimated WIP cost into average WIP holding period. Now, what's important for the WIP is you need to understand that we are talking about in terms of raw material, labor, or overhead, something which is not converted into finished goods yet, right? It's still in progress. Same logic applies for other components as well, even the finished goods. Estimated production divided by 365 days, just that you multiply that by estimated cost of not raw material, not WIP, but estimate cost of production per unit. So that gives you the daily, cost or the daily cost for a finished goods unit. You multiply that by average storage product, and you will get that to a total finished goods inventory. Receivables, we are talking about estimated credit sales upon 365 days. What will give you is a daily credit sales in units multiply by the cost of sales. Now, this is very, very important, guys. Now, we are talking about not counting here, we are talking about a working capital. We are saying we multiply that by cost of sales per unit, excluding depreciation. Here, our agenda here for working capital purposes will always be on cash cost, because we will be seeing what will be the funds block. So that's why the point is we are excluding depreciation, which is not cash cost, which is not part of the cash cost. So we will kind of ignore the depreciation here and any other non-cash cost here, please. Make sure we understand this part. For calculating the receivables, we are only talking about, first of all, do not calculate the receivables by sales. Many students do this mistake. Okay, for receivables, what is my total sales? What is the credit policy? Oh, this is my receivables. Guys, please, from an accounting perspective, what is receivables in your balance sheet in current assets? That's different, right? That receivables is at selling price. That also includes profit. That's include profit also. But we are talking about receivables from a perspective of what is the working capital blocked in receivables. Do you agree with me? Do you understand this point? Do not mix with this receivables with the receivables in the balance sheet. That's accounting. That's core accounting. That is from the sales. That includes profit also. Here we are saying the receivables. We are saying how much working capital is blocked in the receivables. And we are saying cash cost of sales. That excludes the profit. That excludes the depreciation, please. Manish says finished goods include selling and distribution overhead. Manish, we will be looking at in terms of a difference in the finished goods and receivables. In the finished goods, you can see there is a cost of production being mentioned here. And in the receivables, you're saying cost of sales. So when we're doing examples, we will differentiate these two costs as well. So we are saying specifically cost of production. You know what cost of production includes and doesn't include. And cost of sales includes everything, right? So finished goods, for producing finished goods, do you include selling and distribution or that is afterwards? Answer lies there itself. Very, very good question, Manish. And we'll see this point in practice as well. But I want a confirmation from the students here. Are you guys clear on what are we saying in terms of receivables, calculation of receivables, please? Can you guys please confirm? Cash cost is clear to everyone. Do not mix this with balance sheet receivables. So basically, if you see a note on the right bottom, in practice for current assets, debtors, finished goods, we are considering cash cost. That is exact funds that are required. Exact funds required. That will be always lesser than the current assets in the balance sheet. Because normally we say that, okay, receivables are from the sales. Sales is at sale prices, which will also include profit. But profit is not blocked here. Sana, don't worry. That little will go away. You will get confidence very soon. Okay, so what are the components of working capital, guys? Current assets and current liabilities. The last component of the current assets is cash and cash equivalents. Let's say sometimes the banking has a requirement that, okay, you need to keep some minimum balance in the bank. Or let's say company has a policy that, okay, hey, I need this much minimum cash always. We are conservative, right? So current assets have these components. Even the prepaid expenses could be one, right? Raw material inventory, work in progress, finished goods, receivables, cash and cash equivalents, and prepaids. Okay. Bhumika says, sir, in cost of sales, we will include everything except depreciation because depreciation is non-cash. Yes. Yes, 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 yes. Absolutely put in perfectly, Bhumika. And any other non-cash expense. Bhumika, very nice. Okay. So for current liabilities, guys, same formula for the trade payables though. Estimate credit purchase upon 365 days in terms of units multiply by or rather total. So here we're not talking about units here. So total estimated credit purchase divided by 365 gives you the daily purchases multiply by the credit period number of days. So that will give you the accounts payable. How much in terms of the rupees the creditors are allowing you to pay in a relaxed fashion. Direct wages, let's say they give you the wages and they say that wages are paid in arrears. Very simple. So you're talking about a daily wages multiplied by that average time. So let's say if I tell you that, okay, the company pays the wages in 1 month lag. So the 1 month wages will be your part of the current liabilities. Similarly, overheads as well, guys. Right? So I think what we are saying is that, okay, one way to look at is too many formulas. Is this complicated? Trust me, guys, it is absolutely not complicated. This is absolutely not complicated here. Okay, so let's try to understand this and kind of recap entire working. So what is the question could be in a format. The question can ask you, they can give you a lot of information. They can ask you, please provide and calculate or estimate the working capital requirements of a so and so company. So you have to calculate the requirements of inventories for three parts: raw material, WIP, finished goods. Then you would have to calculate the receivables. Then there could be a minimum cash balance. This will be giving you a kind of a gross working capital that is only current assets. And then you have a current liabilities. payables, wages, overheads. And the third is a difference of current liability assets minus liabilities is not yet the current, working capital. Many times what happens is the organizations may want to keep some margin of safety because their estimates can go wrong. So if their estimates can go wrong, you want to have a margin of safety. So whatever current assets minus current liabilities you have got, let's say the company say that we want to have a margin of safety of 20%. So you will have to add 20% here to get to the net working capital. This is more of a tabulation format of how do we calculate. Now, there is a short point at the bottom of this table here. This would be very, very interesting in one of the examples we will be working throughout today, wherein the companies can operate in double shift, guys. And when the companies operate in double shift, do they need additional office space? Do they need additional machineries? Yes or no? Can you please tell me? If a company is operating in a double shift, do they need additional of office space? Do they need additional machinery? Yes or no? I don't think so. They so the workers of one shift will go home, the other shift will come. But yes, what they will need is probably more raw material to work on. They will need electricity. They will need more fuel. What I'm trying to explain here is that if there is a double shift going on, although additional working capital may be required, but it will not be exactly double. Like you can't say that okay into two. It may not be double in proportion. It may not be double in proportion. It may be additional working capital, but it is like some working capital could be increased. One example here is what about WIP? Imagine if there is a WIP and there is a double shift, what the second shift team will do is they will first work on the work in progress left by the first shift. Yes or no? As soon as the first shift people go off, the second shift will come and they will resume the work from there. So they will pick the WIP. They will pick the WIP and resume from there. That means the WIP will actually remain the same because once the second shift guys will end, they will have their own WIP. It will not be double. It will not be double, guys. Although you may have a double the requirement of let's say a wages or a raw material, but WIP will not be a double here. Absolutely not double. That's a good understanding of the use of the resources in proportion or in disproportionate fashion. Everyone ready for a good question here, guys? Want to quickly check is if everyone is ready for a good case study on how to calculate a working capital in terms of this. Okay, let's do then. Sanya, it will not be nil though, but yes, it may be a similar working capital what after the first shift you may had, right? So let's look at a question together, guys. Managing Director of Bhavani Limited is curious to know the amount of working capital that will be required during the year. And we are saying that compute the working capital requirements based on some information given to us. Production during the previous year was 1,20,000 units. It is planned that this level of activity would be maintained. I think that would be a very, very important term. So we are saying here is level to be maintained here. Raw materials are expected to remain in store for an average of 2 months before issue to production. So that means we may need 2 years, 2 months of the raw material here for us. Just give me a quick second. Now we are looking at the expected ratios. Sanya, please mention your question. Whatever doubt you have, you can mention in the query panel. Expected ratios of the cost to selling price is given to us. Raw material 60%, direct wages 10%, and overheads 20%. Okay. Each unit is expected to be in process for 1 month. That means WIP is what? WIP is for 1 month here. Raw materials are being fed in the pipeline immediately, and the labor. Okay, now this is also very, very important line, guys. Raw material is being fed into pipeline immediately, but labor and overhead cost occur or accrue evenly during the month. Evenly means every day there is a labor and overhead as you are working evenly during the month. So basically, if I think of a WIP of 1 month, guys, please try to understand. And I want everyone to be with me on this point. Raw material immediately goes in, but if the raw material goes in for that 1 month production, what do you think? Labor and overhead. Labor and overhead will be if WIP is for 1 month, let's say for the month of March, some labor and overhead is incurred on 1st March, some on 2nd March, some on 3rd March, some on 14th March. Some, every day it's accruing evenly during the month. That means some labor and overhead will go every day. And if I talk about for the entire month, can I say best way is to take an average of it, divide by 2 for labor and overhead? Because they are saying accrued evenly during the month. This is a very, very important point we will consider while calculating. We are saying finished goods will stay in warehouse for 3 months. So finished goods inventory, 3 months. And I think raw material was also mentioned, right? So raw material is 2 months. We will use these, guys. We will use these, by the way. Raw material is for 2 months, WIP for 1 month. For calculating WIP, we have to be very, very careful because labor and overhead is accruing evenly throughout. Credit allowed by creditors is 2 months here from the date of delivery. Credit allowed to debtors is 3 months, and there is a regular production and sales cycle. Selling price is given to be 5 per unit. Wages and overhead are paid on the first of each month for the previous month. Now look at this, guys. From a current liabilities perspective, I'm looking at creditors, I'm looking at wages, and I'm also looking at overdraft or overhead, not overdraft. Now, the company normally keeps a cash in hand to the extent of 40,000. All that would be relevant for us. So, what we need to do is a slow and steady working in terms of whatever information is given to us in the question as of now. I think one factor is which we can consider is what is given to us is a selling price for this. If I have to consider a selling price of 5 per unit, we are looking at expected ratios of cost to selling price. Raw material is 60%. So this comprises of raw material 60%. That means 3 per unit. Give me a second. We are talking about a labor, direct labor. Direct labor is given to us is 10%. That is 0.5. And we are also looking at overhead. Overhead is given to us is 20%. That is 1 per unit. That means we are looking at a profit element maybe 0.5. Sanya says, so if there are two shifts, so the workers in the first shift will produce some WIP, then second shift, labor will complete WIP in finished goods. No, it is not necessary, na Sanya. What I'm trying to say is that even by the end of the second month, the second shift, there would be some units in progress. It may or may not be the case. So you have to see an average, right? It may or may not be the case. You have to see the average. You don't know na what extent. So if I go by your assumption, that is only possible if the WIP by the first shift are exactly at the 50% stage. So you never know, right? Okay, coming back to this question, guys. Everyone agree with the given information here? Raw material, wages, and overhead. So can we guys quickly start calculating the components of the working capital? And when we say start calculating the components of working capital, we first target on current assets. Current assets, I think one thing is given to us, right? Cash. That I think that I can tell you. Right? So cash in hand is 40,000. What is important is inventory. In inventory, you would be needing three things: raw material, WIP, and finished goods. So let's see who gives me answer for the raw material, guys. Raw material. You have information on my screen and you have to tell me what is the raw material requirement here. Very, very easy. Just apply yourselves. You may need the production number which is given to you. Same production of the last year, 1,20,000 units. 1,20,000 units. Nikita comes with an answer. Nikita says 30,000 here. Mind you, you're talking about raw material for 2 months. I can actually help you guys to calculate the raw material so that you guys can maybe take a lead from there. So you're talking about 1,20,000 units for the year. How much is the raw material cost? How much is the raw material cost? Any thoughts? From an overall understanding perspective, we are talking about 2 months. I think 3 per unit. So raw material cost is 3 per unit. And you are talking about 2 by 12 here. That's 2 months. So what is this? So is the raw material 30,000 or 60,000? I think I'm getting 60,000 somehow. Let me see your answer. I think, yeah, I'm getting 60,000 by majority of the students now. Nikita, did you check your calculation, please? So we're getting a 60,000 raw material. Now it's very, very important that for WIP, now raw material was for 2 months. WIP was 1 month, but between the WIP, within the WIP, we have to be very, very careful. WIP is 1 month overall, but for material, it could be 1 month, but for labor and overhead, you may take 0.5 months because remember the labor and overhead accrued evenly. That's what is given to us in the question. So who will give me the calculation of WIP, guys? Raw material 1 month, labor and overhead half month. Or you can say 1 month divided by 2. Someone may argue that, sir, why we say 0.5 months? What I'm trying to say here is it is also 1 month. It is also 1 month. But since it is accruing evenly throughout the month, I multiply that by 1 by 2. So what's the WIP amount? So WIP, in the WIP, if I calculate the material, 120,000 into 3, that's your material, into 1 by 12. Is that how you will be calculating? The raw material here. Hence, we are calculating within the WIP material worth 30,000 will be stuck. Labor and overhead. Now, labor and overhead combined is 1.5 per unit, guys. So 1.5 per unit, 1,20,000 into 1.5 into 0.5 by 12 here. So we are saying 1,20,000 into 1.5. I'm getting 7,500 for a labor and overheads. That means total WIP is 37,500. So we got a raw material of 60,000. We got of a WIP of 37,500. Everyone okay? Sanya, something needs to be checked there. we're getting 7,500. Even Bhaskar, Nikita, Kadambri, Partha, very nice. Some people already got 37,500. Very nice. Because we have to be very, very careful in the debtors, or rather not in the debtors right now. We are going on to the finished goods first. Let's see what is the finished goods going on. Finished goods should be straightforward, isn't it? What do you think? We have 3 months of finished goods. First, I want a confirmation for WIP. Everyone clear, guys? Because labor and overhead could be tricky because it accrues evenly throughout the month. Eh? Sanya is saying WIP is for 1 month. Why raw material and WIP is for 3 months? Where did I mention three? Sanya, that three is rupees three, right? Material is 3 rupees per unit. For the period, I have done 1/12 only. Three is 3 rupees. Finished good is how much, guys? Finished good is 3 months, right? So finished goods we have 3 months. The total cost of the finished good is 4.5. That's what we calculated. And we are looking at 3 months. What is the finished goods inventory we are getting? What is the finished goods inventory we are getting here? I am getting 1,35,000 finished goods. Sanya says did not understood. Sanya, my question is why you are saying WIP is 3 months? Where did I mention 3 months? We have taken material for 1 month only, na? We have multiplied by 1/12. That 120,000 into 3, 120,000 is unit. Please look at the top. Your selling price was 5 rupees per unit. Raw material is 3 per unit. So you have to multiply the units into per unit cost. So the total raw material to be purchased during the year, total raw material purchases during the year, what would be the raw material purchases, guys? Purchases in the year would be 1,20,000 because those are the units to be produced into 3 per unit, 3,60,000. That's why I multiplied by 3. This 3,60,000 into 1/12 is 30,000. Okay, I hope it is clear now. So for a total inventory, guys, we're getting 60,000 plus 37,500 plus 1,35,000. So we are getting a total inventory of 2,32,500. Next one in our radar is calculation of account receivables, guys. Let's say who will give me the account receivables. Account receivables should also be very, very straightforward. In this case, in this question, we are not yet given any depreciation, I guess. So we can take the cost, and the credit allowed by the debtors is allowed to the debtors is 3 months. 3 months. So what should be my account receivables? It seems account receivables should be same amount as the finished goods, I guess. So 120,000 units multiplied by the cost, cash cost, because we don't have depreciation, we are taking the entire 4.5 into 3/12. So this is another 1,35,000 here. Sanya, absolutely not a problem. You guys can ask me same doubt multiple times. Do not worry. Askar, what was that answer for 58,000? I don't know. I think receivables should be 1,35,000, I guess. So because if we get this answer, we are looking at my total current assets, gross working capital or current assets would be 4,07,500 guys. Bhaskar, need to check your answer, please. Nikita says debtor calculation not understood. Nikita, debtor I explained you make the sale to debtors at 5 rupees, right? 5 is your selling price. But but that debtors are accounting debtors, right? We are talking about from a perspective of how much working capital funds are blocked. So is profit element is also blocked in the receivables? I don't think so. Do not confuse the debtors what you record in accounting balance sheet here. Here we are looking at from a working capital fund blocked. That is only material labor, so cost of sales. So it may include other expenses as well. In this case, we don't have any information about selling and distribution as well. So we will not include any depreciation, any non-cash will not include the profit. So here, based on the information, we only have the cost of 4.5 per unit. What about others, guys? I hope everyone with me on this, because with this, we can quickly latch up on to the calculation part of current liabilities. We can move on to the current liabilities. I think in terms of the creditors, what is the information given to us? 2 months. So 120,000 into 3 into 2 by 12. 60,000 is your creditors. 60,000 is your creditors, guys. And then you have a wages and overheads payable for 1 month as well. Wages and overhead. Somewhere in the last line we have mentioned here, wages and overheads are paid on the first of the each month for the previous month here. So expenses outstanding 120,000 units, and this is 1.5 into 1 by 12. I think that is 15,000. So you're looking at a 75,000 for a current liabilities. Hence, your working capital in this case is current assets 407,500 minus current liability 75,000. We are getting a 332,500 here. Now, had there been in the question in this case any requirement of any safety margin, let's say I tell you that there is a safety margin the company needs. Gunjan says whatever capital introduced, not yes, absolutely. Debt, so working capital blocked in the debtors is not inclusive of any profits. That's over and above. Okay, so what if the question said, so answer for the working capital is 332,500. That's pretty much correct. You guys can check your calculations. Everything is pretty fine. But what I'm trying to say is that if there was a question in the question itself, let's say there was a margin of safety required of 10%. In that case, my working capital would have been 3,32,500 plus a margin of safety 33,250. That would have been your working capital in that case, if there was a margin of safety. Partha, that's what we have included now. 10% and 20% is like 30% of 5 is 1.5 per unit. So we have already included wages and overhead. We have already included 1.5 per unit here for 1 month. I hope that makes sense to all of you guys. I hope with Bhavani Limited, you are getting hang of it, how to calculate the working capital. It's a good comprehensive question to understand the things. Everyone clear on that? Okay, Manish says so. Margin is applied on the net W. Yes, on the net working capital. Very rarely, if the question says otherwise, you will have a net working capital margin on the net working capital. Very nice, guys. So I have a homework question for you guys. Right now, I'm showing you on the screen. This is a homework for everyone. Why this is homework? This is very, very simple. Based on whatever we have done so far, absolutely very, very similar. And there is a smiley at the end of the question. There is a homework question, which is very, very similar. And the only thing is, in this case, I can just tell you what are the add-ons. You have administrative expenses. You have sales promotion expenses. This will be included in cost of sales, mind you. And you have these expenses also in arrear and paid in advance. So you have outstanding liability. Tanishka, I think, let me check. No, Tanishka, before this, I don't recollect and I don't see your message quite a while ago. The only message I can see yours is, sir, are you able to see my messages? So that means if you had sent any message, let's say in the last 10 minutes, I could not see any message. I don't know if it could be some technical glitch. You had any doubt? Let me know, please. Please let me know if you had any doubt. I cannot see any of your, in fact, any message, maybe since we have started this question though. Okay, continuing my advice for everyone for this homework is, uh, you can see they're mentioning the depreciation aspect. Depreciation is considered as part of the cost of production here. It keeps 1 month stock of raw material, finished goods, and cash balance is given, and 20% safety margin is given. And the last part, there is a smiley, because the smiley is because there is this question tells us to ignore the WIP. Ignore WIP. So this is a very, very straightforward question. The only thing is, instead of a WIP, what we have added in this case is, the debtors would be based on the cost of sales. That means the last two elements. So we are talking about the cash manufacturing expenses. This will be included for cost of production, for WIP, for finished goods. But if we look at the aspect of the entire expenses in terms of whatever we have, uh, we will be talking about even this to be included in cost of sales. So even these two will be included in the cost of sales here, right? I hope that makes sense to everyone. So I think for cost of sales, you will have material consumed, wages paid, cash manufacturing expenses, administrative sales, everything. So it's like more of a 12 lakh 90 plus 180. So we are looking at everything included in the cost of sales. So this is something you have the answers with you, but I want you guys to solve this on your own. This is a homework question for everyone. Pretty simple one. Okay, couple of questions. Well, calculating liability of wages payable is for half month or full month. Sanya, that was only for the WIP, right? WIP. But for the wages, it was clearly mentioned in that question towards the last. Wages and overhead are paid on the first of the each month for the previous month. That was only for WIP. Bhumika said, sir, for advance, we will add 1 month of advance, and in case of a year, yes. So Bhumika, for the homework question, for advance, please treat it that as a prepaid expense as part of the current assets, and for the arrear, it is more of a current liability. So you will have the prepaid expense here. This will be a prepaid expense. Okay, Manish, will see that later on. I need to check what you are saying. And if in case that question is not covered by me, you can definitely mark your query to our email ID. There has to be some catch in that, right? Okay, right now with 810 guys, I would like to talk about a very, very important question, right? This is very much from your study material. This is very, very important to understand. And this is a question of submarine enterprises. I would request anyone here uh, could please mention what is this page number as per your study material right now for everyone's benefit. So this question is of submarine enterprises. It used to be illustration 9 or something like that. And this question talks about of two shifts. This would probably be having two solutions in your study material. We will be focusing on only one solution in the class because that will be the requirement of the question actually. Okay, so we are focusing in the last 20 minutes. Bhaskar is giving me an answer 9.31. Thanks, Bhaskar. So this is on page number 9.31. Very nice, Manish, Nikita, Bhumika. Thanks, everyone. Partha. Gunjan has a very, very interesting question. What we learn through this study chapter. So, Gunjan, we are talking about working capital, right? You learn to calculate working capital. You learn the short-term, financing requirements, and then you would be going to individual components in the next couple of classes as well. So this is illustration 5 now, page number 9.31, what everyone has just confirmed. So Submarine Enterprises has operating its manufacturing facilities on a single shift working with the following cost structure. So presently, they are doing a single shift. This is current scenario. Cost of material, wages of which 40% is fixed. So if I have to just quickly jot down what is fixed versus what is variable. So variable would be 3 and fixed would be 2 out of 5. Similarly, overheads, variable will be 1, fixed will be 4. Profit may not be relevant for us, not relevant. Selling price of 18. So we may be worried about the cost here. So sales during this 432. So I have to quickly divide 432 divided by 18. What do I get? I think we will getting how much do we get, guys? 4,30,000 divided by 80. 24,000 units. So that means we are currently operating at a level of 24,000 units, right? So in the view of increased market demand, it is proposed in the view of the increased market demand, it is proposed to double the production by working an extra shift. So we're talking about a double shift here. It is expected. Now look at the changes, guys. With a double shift, the first change is 10% discount will be available from suppliers of raw materials. So that means raw material will be 6 minus 10%, 5.4 per unit. Selling price will remain the same. That means we are looking at a selling price of 18 per unit. Nice. Credit period allowed to the customers will remain unaltered. We'll see that. Credit availed from suppliers will continue to remain at the present level. So credit availed from suppliers is given to us directly as 2 months. But credit period allowed to the customers we will cease from some other information. Lag in payment of wages and expenses is half a month. So outstanding expenses, half a month. You are required to prepare the additional working capital requirements if the policy to increase the output is implemented. Now, there is one more thing, is in your study material, I'm sure you guys can see there are two solutions. One is if this is implemented permanently, and we will solve that way because that is the requirement of the question. I think one way, if you see the alternative solution, and you guys can confirm to me, is what if this is just as an exception? This is just to meet an extra additional demand for that moment. So then it is not a permanent solution. So that in that case, your answer may slightly differ due to the creditors and other carryovers, because this is just one time double shift. So we are not solving this question like that in the class though. You can refer to that particular alternative solution later on. But what we are seeing here is what if this is implemented? So as a policy implementation, what would be my working capital? But there is some other information given to us on the right hand side. So company held a stock of raw material at cost 36,000. So in number of units, guys, can anyone tell me what is this stock of raw materials? If this is just 36,000 at cost, can we say it's like 6,000 units? Work in progress valued at prime cost. What is my prime cost, guys? Prime cost is like material plus labor. So 6 plus 5 is 11 per unit. So if 11 per unit is my work in progress, this is 2,000 units. And I already have some kind of a alarm bell ringing in my head. Double shift, work in progress. Double shift, work in progress. Double shift, work in progress. Something was being discussed at around 6:56 p.m. today, right? I don't know if you guys remember that. Finished goods valued at total cost of 16, right? Total cost is 16. So 72,000 divided by 16, we're getting 4,500 units here. And we have a sundry debtors as well. So sundry debtors, again, it seems in terms of 6,000 units. Because we have a selling price of 18. So if you divide by 18 here, you get 6,000 units. Sanya, the question, while calculating working capital, is it assumed that all units purchased raw materials are sold? Hmm? First of all units purchased as raw material are consumed, you are saying, right? But why? We are calculating the inventory of raw material, right? Sanya, sorry, just let me know if in case I am misreading your question. You think all units purchased as raw material, na? Raw material will be used in the production and we are calculating the inventory of the raw material as well. We are calculating three inventories, na? Raw material, WIP, finished goods. Sanya, I hope that makes sense. Now, guys, for this particular question, I want to talk about something, guys. Before we even go for calculating the working capital, please, we have discussed almost an hour ago that with double shift, there should not be any impact on WIP because the second shift will work on the WIP and they will have their different WIP. It may be same, similar. So, unless given something else in the question, we may assume that the same level of WIP will be at the end as well. Now, my point here is that do you think with the double shift, all these costs will double? Gunjan says, why overhead not included in WIP? Gunjan, we can't challenge the question, right? Because question says work in progress valued at prime cost. We're not challenging the question here. Okay. So, but my question is like raw material may be doubled. Wages and overheads have some portion of fixed cost, guys. What do you think? Fixed cost will change or not? Sanya, raw material will indirectly impact everything, right? Raw material inventory and even for the finished goods, you will have the raw material included in the finished goods. So just wait for the walkthrough, you will understand. Now, first thing I would like to talk about here is with the double shift, guys, it's very, very important to understand what will be my cost level before we even go to the, what will be, we go to the double shift. So let's do our working here. So we have already done some of the calculations. We have already done some of the calculations. We are saying that, okay, sales for the current year is at 18. That means present volume of 24,000 single shift. That means for a double shift, we are talking about a 48,000 units. So we arrive at these two sections on the top of the table here, 24,000 and 48,000. Closing stock, we discussed 6,000 units, single shift. Now the closing stock for WIP is 2,000, but there will not be any change. So we are saying that we are assuming that, okay, 2,000 will be end of the first shift and the double shift. We are just assuming that, okay, the same number of WIP units remain at the end of the WIP shift. That is 2,000 units. Closing stock, again, we have already calculated 4,500 units. But now we understand. Please see what we are doing here is first I want everyone to focus on this statement of cost only for 24,000 units, please. I want everyone to focus on only on the first part, 24,000 units as of now. Material 6 into 24,000, 144. Wages we have divided into two. We remember we discussed 3 as variable, 2 and fixed. So 3 into 24, 72, 2 into 24, 48,000. Overhead was 1 and 4. 1 is your, a variable, 4 is fixed. And total cost is 16. So we should be as a group here. I want everyone to be on the same page on the 24,000 units column. Is everyone okay for 24,000 units? I hope everyone is doing fine for 24,000 units. Please make sure that you guys are absolutely doing good. Now, let's look at what changes as 48,000. What are the changes here? What we are looking at, the first most is my raw material were discounted at 10%, right? Instead of 6, it's 5.4. 10% discount. What we also know that selling price doesn't change. The selling price is still 18. That means from a revenue perspective, I'm saying 4,32,000 into 2 is 8,64 because we are now operating at 48,000 capacity. 24,000 into 2. Now, in terms of the wages and the overhead, the variable cost will change. See, the variable cost per unit will be same, right? Whereas the total fixed cost will be same. We know this. So the variable wages will be 3 per unit. So it will double. Similarly, variable overhead will be double, 24 say 48. But look at the two circled amounts. Fixed wages, fixed labor cost, and fixed overhead cost doesn't change. 48, it stays 48 and 96, irrespective of double shift, unless they gave us some information that, okay, hey, we had to hire some supervisor or whatever. So the variable cost, Bhumika has a question. Production level increases, variable cost decreases. No, we are not bringing in efficiencies is just in two shifts here. Volume is double, na Bhumika? Volume is double, so variable cost per unit is same, but total variable cost will be changing, right? So the total variable cost will change. Variable cost per unit is same. Now what's happening here is, guys, I can pretty much see because now here I want everyone's attention. Because my fixed cost, my total fixed cost is same. Do you see the impact? Do you see the impact here on the per unit, please? My fixed wages per unit are from 2 to 1 and fixed overhead per unit is from 4 to 2 because at a total level that fixed cost was constant. So 48,000 divided by 48,000 is 1, 96 divided by 48 is 2. That means my total cost is now from 16 per unit has gone down to 12.4 unit per unit. That's the synergies, that's the economies in cost because of double shift. It's no longer 16 per unit, guys. Profit is increased. Profit is increased because my cost has also. So, but the interesting point is, some of you would have been expecting that for profit should have been 48,000 into 2, 96,000. No. Can you see? Profit is not 48,000 into 96,000. Profit is actually multiplied much larger. It's 2,68,800. It's not in proportion of the volume exactly. Profit is huge here because some of the costs were the synergy, some of the costs were saving, some of the costs stayed fixed, did not double. I hope everyone with me on this. There was a discount also in raw material. So a lot of factors bringing in that profit to a significant number here. Because now if you understand the statement of cost for double shift, that's where the working capital calculation will start now. Because if you now understand the working capital requirement, the rest is history for us. The rest is history for us. We can now quickly look at the working capital calculation using the statement of cost numbers. So let's focus on the single shift as of now, which is already given to us. Single shift is given to us, right? Which is kind of conceptualizing what is given to us. These are given numbers. So raw materials, 36,000, right? I think this is coming in from the information here on the right hand side on your screen. Kunjan says change in shift time labor costs also increase then. That's fine. Huh? Some costs will increase. Some cost increase. We have already taken that into account by doubling the units. Okay, so you have a stock of raw material WIP finished goods given to us. So 36 22, 72, 96. I think all this given to us, right? Debtors is also given to us. 10. So, okay. So that is a interesting fact. The debtors given to us was 1,08,000. That was at selling price. But do we include the debtors at selling price? So we have to be very, very careful. For debtors, we are using the cash cost. So 6,000 into 16 and not 18. So the debtors numbers changes. We are not taking the 1,08,000 as is here. Manish, you are absolutely correct. So guys, everyone with me, very, very careful that whatever information is given to us, we do not take as is. Make sure that we calculate the debtors as per the cost by impact, not including the profit, not 18 per unit. And then they were given to us a credit from suppliers for 2 months, right? So credit for supplier for 2 months is 24,000 divided by 12 into 2. What do you think? In terms of the calculation of the creditors, we are talking about 2 months. Per month is 4,000 units. So in terms of units is 4,000 into 6 is 24,000. Similarly, credit for wages and expenses was given to us. Credit for wages and expenses were given to us was half month, 0.5 months. So that means we have taken 1,000 units here and each multiplied by wages and expenses, 5 each. So you're getting a working capital of 1,92,000. I want everyone to be crystal clear on the single shift working capital first. Tanishka says she did not understand the 16 rate. Tanishka, if you go to the question and if you remember that working capital includes account receivables, but for the purposes of working capital, we do not value the account receivables at selling price because selling price includes profit also. Profit is not your funds blocked. Profit is a return you're expecting, but that's not your working capital blocked. So if you see the question itself, where the table says sales per selling price is 18, which includes a profit of 2. So 18 minus 2, 16. It's right here given. So 18 minus 2, 16. So you are only operating at this level. Sanya had a question. Wages do not include, does not change sorry, WIP does not change and WIP include wages. So how wages is double? Sanya, there are two different elements. There are two different elements. Inventory is a different element. Wages is a different element. So workers, you will have double workers, right? One in day and one in night. What happened? WIP is only for inventory perspective, but there will be two different people coming in, one in day and one in night. They will be doubled, at least for the variable cost, not for the fixed cost though. Kadambari says crystal clear on the single shift. How many of you are crystal clear on the single shift? Someone can be diamond clear, someone can be ruby clear. I need to just quickly check if you guys are clear on the single shift. Now, for the double shift, guys, we are just kind of using the same cost numbers. Make sure we are operating at a 48,000 units now for a double shift. That's why the raw material gets doubled, but at a reduced rate. Raw material, we are not including 6,000, but 12,000 now, but at 5.4 because 10% discount tha. So you could say that, okay, you can absolutely do a shortcut here, 36,000 into 2, 72,000, but there is a 10% discount. So we get a 64,800. Work in progress, that is very, very important now. Sanya says, sir, can you please explain the debtor part again? Sanya, debtor doesn't include profit. So debtor may we are only including the cash cost. So 16 per unit. Okay, work in progress. Guys, work in progress was valued at prime cost. Can you tell me the new prime cost now? Can anyone tell me the new prime cost now? The new prime cost will be wages, direct material plus labor, 5.4 plus 3 plus 1. Do you agree with me? The prime cost per unit changes from 11 to 9.4. The prime cost changes from 11 to 9.4 because of the savings in the fixed cost. Savings in the fixed cost and discount in the material. So both the factors considered, there is a new prime cost now. So the WIP in the units is same 2000, but the value has gone down because of the synergies, because of the economies, because of the fixed cost, because of the discount in the raw material. So prime cost goes down. So everything depends on your working capital calculation, entirely depends on your cost sheet. Your total cost was 12.4 from 16. It went to 12.4. I've already explained this. So we are taking that 12.4 to calculate your finished goods and debtors both. The only thing is the units are doubled. Instead of 4,500, finished goods is 9,000. Debtors were on 6,000, now on 12,000, because you are operating on double shift, more sales. Earlier you were talking about 24,000, now you're talking about 48,000. Earlier you were talking about debtors for 6,000 units, now we are talking about debtors for 12,000 units. So your current assets requirements is actually now 3,44,000. And same we apply for the materials, your accounts payable, your sundry creditors. Instead of 4,000 units, we calculate on 8,000 at 5.4 because they gave us the discount. So creditors are 43,200. Wages and expenses similarly at 4 and 3 respectively. Now, where this 4 and 3 coming up? Again, wages 3 plus 1, overheads 1 plus 2. This is again coming from the cost sheet. What is interesting as a conclusion in this particular case study is that if I calculate my working capital, it is not doubled, guys. One would expect that, boss, acha, there is a working capital of 192,000 in the double shift. Should it be a 384? Absolutely not. You are talking about a lot of savings here. You're not required 3,84,000. So the additional working capital is hardly 50%, guys. I think I think this company decided good, right? Submarine Enterprises is probably hiring a chartered accountant like you who believe that okay, we can probably by having 50% more working capital, we can double the shift, we can double the revenue. Because you can see that the working capital was 1,92,000. By just having additional working capital of 94,800, you got to double shift, you generated multi-folded revenues here. It's a very, 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 very good question, guys. I guess all of you would agree with me that the neve of this question, the neve of this question revolves around two factors. One is you read the question very, very carefully, try to capture the information very, very carefully. And the second is drafting the cost sheet very accurately. Understand the synergies in the material, in the fixed cost, changes in the prime cost, changes in the total cost. If you understand these two parts, calculation of working capital would be merely a arithmetical work here then. But it's very important that you guys spend some time on this question, this illustration. I'm sure this discussion would help you to go through this again. Can I get a confirmation from everyone here? That I'm sure like some of you, Gunjan, Bhumika, some people have already confirmed. What about others? This is a very, very good, overall exercise to make concepts clear in a lot of things. Can I get a confirmation on the query panel? Okay, very nice. So Hardik and Tanishka as well. Great. Superb, guys. So I think we can stop here. It's almost 8:35. We can stop here. We will be meeting again on 13th, I believe, as per the schedule, and we'll be moving on to the other parts of the working capital management. We move on from here to treasury management. We will also look at other parts after the treasury management in terms of the cash budgeting. So a lot of interesting fun lies on the other side of, or other in the second exercise. We'll be looking on to the cash budgeting, and then we will be moving on after the cash. We'll be moving on to the account receivables, accounts payable, a lot of fun. And so we have two more sessions coming up. We'll be having a lot of conceptual discussion on Wednesday, a bit on Saturday, but then towards the end, we'll do more questions practice on next Saturday, I guess, as well. So keep on the good work here. Wish you all the best. Keep on the good work. Just make sure that we remember that those three shortcuts for success you guys are tired of hearing. It's like practice, practice, and practice, guys. So that's only you need. And I'm sure you guys are not leaving any stones unturned here. Great, guys. All the best. Take care. Good night. Stay safe and happy learning, guys. See you again. Take care. Cheers. Bye bye.